Hello, and welcome to another episode of the Seasonal Tokens Podcast, where Polar interviews people so you can do more investing and less gambling.
I'm not pretty familiar how the tax law is in the United States, but do you have to pay taxes if you're just holding or, for example, also staking?
Yeah, no, not if you don't sell, right? So if you're hold, it's not selling, or if you're staking, you're not selling. You don't recognize the gain until you exit, right? And now, obviously, the downsides of staking in places like Celsius are places that went under because they couldn't deliver, and all the reasons why there was a big cash call. This is why we believe the deferred sales trust is great, because you literally exit out of the crypto ecosystem when you feel it's unsafe, or when you feel that it's over leveraged, or feel that the market's high, and you buy back in when the market's low, but you do it without having to pay the capital gains tax. You get to defer the capital gains tax. So in and out, by the way, both ways. So you can sell high, defer the capital gains tax, and you can buy back low, still deferring the capital gains tax, and kind of ride those waves up and down if you do it correctly the way we work it. But yeah, you're right. If you just stake something and borrow against, or take a margin against it, and or don't sell, then you're not subject to capital gains tax. So in our scenario, the way we work is we transfer the coin to the trust, and the owner of the coin now becomes an owner of a promissory note, and they are owed back the amount that went into the trust plus a rate of return over a period of time. So they're becoming the lender, right? They're becoming the lender, but it's with an outside trust, right? Our role is the trustee. We perform that service, and it's that part of it that allows you to keep the tax deferred. Does that make sense, Polar?
Yeah, absolutely. But if you can put it in even simpler terms, I think it would be very beneficial for our listeners.
Yeah, we can try that again. So I'll just do the actual deal we did. We did for $7.5 million for an Ethereum client.
Okay.
We opened up a Kraken account for the deferred sales trust. It's a brand new entity that's set up, and he transferred the first $5 million within about 1 hour. He transferred the coin to the trust account, and the trust gave him a promissory note, which means basically an IOU. The trust says, I owe you the $5 million plus typically about 8% on that. Now, the neat part is, remember, he transferred $5 million. He also lives in California. He had about a $1.85 million tax bill that is now deferred. It's all deferred. And this $5 million is invested into stocks, bonds, mutual funds, real estate, whatever he'd like, back into crypto. And he's going to live off the interest of the $5 million and pay tax slowly. So the key was he didn't sell the Ethereum to the trust. Well, he did, but he carried back 100% financing. He didn't sell it for any monetary payment. He received a promissory note. So he lent the $5 million to the trust, and he's going to receive it slowly over time. But he doesn't pay tax until he receives the payment. He went on to do another deal for $2.5 million. So now he has $7.5 million, and out of about $13.5 million that he had accumulated. So that's the short answer of how it works. And someone might say, well, why isn't the trust paying tax? Well, the trust bought it for $5 million and then ultimately exited for $5 million to the marketplace. So it receives $5 million in cash, and then we exit it to a U.S. bank, and then we start investing in different investments. So that's kind of that order. Because it bought and sold for the same price the trust did, there's no gain there, right? And since the ultimate seller hasn't received any of the $5 million yet, he's in a deferral state.
Okay. Now it makes perfect sense. So thank you very much for this explanation. So I suppose that due to the fact that tax laws are not the easiest thing in the world, people are doing a lot of mistakes regarding to that. So are there something like most common mistakes that people are doing with their crypto taxes?
I think just the biggest thing would be not tracking and not properly reporting be probably the two biggest mistakes. Either they're not organized or they're not as urgent with that. So I think you need to make sure that you're very clear on what you bought your positions for, your coins for, and that when you sell it, you're also very clear on reporting that on your tax returns. So those are the two biggest ones. I think everyone knows there's taxes, right, when they sell. And so, of course, we think the biggest mistake, especially if it's over $1 million net proceeds, $1 million gain, which, by the way, that's our minimum. You need to have at least $1 million net proceeds and $1 million gain for our strategy. That's our minimum. And so if you have that and you're selling without us, you'd have to ask yourself, why would you want to pay the tax? Unless you want to just spend it on a bunch of personal stuff, like a primary house or a bunch of just primary consumption. But if you want to do business or investments, then you might as well defer it with the trust, kind of like an IRA, kind of like a 401k, which are ways to grow wealth tax deferred. So those would be the two, I guess, the three main ones, if you will.
Great. And regarding to that, I suppose that people are definitely not familiar with what exactly you do and how exactly they can exit like a millionaire, like you have mentioned. Mm-hmm. But I suppose that this is leading to a lot of questions. So what are the most common questions that you hear from your clients regarding to your service and capital gains taxes as a whole?
Yeah, one of the most common questions is, how do I know it's legal? Right? And the Deferred Sales Trust has thousands of transactions, billions under management, over a 25-year track record, and over 20 no-change IRS audits. Okay. And that gives people certainty and gives me certainty and confidence that this has been tried. This isn't something new, been tested by the IRS. It's passed. We've had national law firms review it. One of the biggest deals is over $125 million deal that was audited in California, no problem. And so the first one is, is it legal? How do I know this thing is legal? And can I trust that the people who set it up are going to stand behind it if I get audited? And the answer is yes as well. The tax attorneys we work with provide lifetime audit defense, and they're the ones that have defended the trust against the IRS for over 25 years. So that's the first one. The second one would be, how do I know the funds are protected, or, who's this trustee? That's our company. And how do I know I can trust that they're not going to take the funds in an inappropriate way, right? Or invest them in an inappropriate way? Well, we have safeguards in place where the funds only get invested as you approve the investments. Now we have to approve them as well. It's like a check and balance there. And we also use third-party financial advisors, third-party banks, and you get 24/7 access to view the funds online. And we work closely with you to help you understand what it is, how it works, all the safeguards in place. And we also work with your CPA to help to report it properly. And then the trust files its own tax return, which you also get copies of. So everything is transparent and everything is also confidential to the individual client. And we have those two things in place. I think the next one would be just understanding how flexible it can be. People get, they're like, wow, it can be so flexible and so neat that I can invest into real estate or businesses or back into crypto, the stock market. And the biggest thing is, I think sometimes people just think it's too good to be true because they've never heard of it, or they've never done it, or they don't know someone who's done it. And so they're hesitant because they think, maybe something is off here, but it's not. It absolutely works. And we just have a very specialized skill set and knowledge, and our experience in the past is allowed us to create this and to execute this, right? So it's not just the idea, it's the team to execute the strategy that I think people will learn as they spend time with us, of how specialized we are and how we're able to execute on these plans.
Amazing. Yeah, definitely. When you mentioned this for the first time, like, I was really thinking if this is possible, like how the law is allowing you to do something like that. But I suppose that, like you just said, it's really important to have the right knowledge and the right team to achieve that. It's not that easy, actually.
Yeah, we can actually talk about that too. We think it's a win-win for everybody, including the IRS, including the government, including obviously the person who's selling the crypto or the business or the real estate, and us as a trustee. Because what it allows you to do, again, take the case of the 69,000 per Bitcoin. Had my client exited at that point, all of that capital gains tax would have been deferred. All of that wealth would have been maintained, right? And it would have been put into likely stocks, bonds, mutual funds, commercial real estate, business ventures, right? In other words, these are the things that actually, the government sees that spurs economic growth and jobs and creates jobs. And these jobs create revenue, right? Tax revenue. And as well as it allows us to pay taxes on our fees, right? And the capital to be deployed into the economy. It's a study of macroeconomics, which states that if we keep money flowing and moving and redeployed in different projects, like we have a housing crisis going on right now in America. And part of that, we need more apartment buildings to be built. And it's very expensive to do that. And now debt's going higher, interest rates are going higher. And so how do you incentivize private citizens who have a lot of wealth to create housing, well, you give them tax incentives on the housing projects, and you also give them tax incentives to move capital from one place to another, like opportunity zones or 1031 exchanges, like a deferred sales trust.
Yeah.